Hello, investors. In July, the market sentiment remained positive due to a decline in inflation in developed markets and strong GDP data. This boosted hopes for a smooth economic landing and led to a broad rally across economic markets. Global stocks performed well, with the MSCI World Index rising by 2.13% in sterling terms. The S&P 500 and FTSE 100 saw roughly 2% and 2.3% increases respectively. But it was the riskier regions and sectors that performed the best. Smaller cap stocks in the FTSE 250 and the MSCI Emerging Markets Index showed strong gains of 4.67% and 4.96%, albeit this is after several months of underperformance in the first half of this year. Fixed income also experienced positive returns overall, with global bonds rallying 0.7% during the month. In the UK, gilts were slightly up at 0.75%, supported by a lower than anticipated June consumer price index, which was down to 7.3% from 8.7% in May. At its early August meeting, the Bank of England raised base rates by another 25 basis points, following their counterparts at the US Federal Reserve, who raised rates at the end of July. Both major central banks have signaled that inflation seems far stickier than previously anticipated and have not ruled out further hikes in the future. Sterling benefited from these additional hikes, with the pound rising 1.1% against the US dollar in July. On the 1st of August, Fitch Ratings, a renowned credit rating agency based in the US, downgraded US debt from once the safest rating of AAA to AA+. The last time this happened was in 2011, following the Great Financial Crisis. This is a significant market news event and follows the negotiations on the debt ceiling the US faced in June. Effectively, it is saying that the US government and economy is not the safe haven it once used to be, and there are troubles brewing underneath which need to be dealt with. The downgrade could have widespread repercussions impacting mortgage rates and financial contracts worldwide. As a result of any potential US Treasury sell-offs, yields may rise, influencing interest rates on various loans. Fitch's rationale for the downgrade included expected fiscal deterioration over the next 3 years, following a government debt burden and declining governance standards. Unsurprisingly, the S&P 500 stock index fell significantly following the downgrade. We are paying close attention to the undercurrents of this news story, as we believe there could be further downside ahead unless fiscal actions are taken by the US government. The end of July marked the beginning of the US and European second quarter earnings season, where companies report on their revenue and profits and CEOs give their growth outlooks for the remainder of the year. The results have been mostly good, with major companies beating analyst expectations. However, it is important to note that expectations have been vastly reduced compared to how they were 12 months ago. Many large cap names beat expectations, with the exception of Apple. However, almost all CEOs gave gloomy outlooks for the remainder of the year, mentioning tightening credit and major headwinds for the global economy. Elon Musk was noted as saying that as new car demand is mostly financed, he is expecting a downturn in sales at Tesla in the coming quarters. This is not unsurprising given how quickly and fast rates have risen in the last 12 months. In hindsight, we may have been somewhat premature in our defensive positioning for the first half of this year, particularly given the unusual positive returns of the S&P 500 and tech-heavy NASDAQ 100 indices. But we feel protecting our investors' capital is just as important as growing it over the long term. Looking forward to the second half of this year, we're expecting some correction given the recent news on the US downgrade, further rate hikes, and the gloomy earnings forecast as aforementioned. In early July, we used the proceeds of the earlier sales to increase our holdings in the FTSE 100 index and a fund that tracks the Asian stock market, excluding Japan, which both reached our predetermined re-entry points. We're now exposed to our full weights in these regions. In the short term, both transactions have worked out well thus far. We are revisiting our entry points for Europe and for upweighting North America, namely the US, as we feel the market index is somewhat detached to the local economy. Think of, for example, the likes of L'Oreal or Microsoft, who derive their revenue globally and not just in Europe and US, respectively. A domestic market downturn might be milder and short-lived in these indices. As always, we encourage you to contact your financial advisor should you have any immediate concerns. If you have any further questions for us, we of course welcome them and ask our clients to contact us on the email on the bottom of the screen. Thank you.